Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome back. Again, Art Jarvis for episode number 11 of Taking Stock.
As always, happy to be here.
And it's good to have you with us again. Share some insights about what's happening in the marketplace and in our economy.
Yeah.
So, we are 100% flying blind. Folks that are listening, we did not do any pre-show interview or anything for that. We're going to talk marketplace and economy just right from the seat of our pants. But Art knows this stuff, so he's our expert. So what's top of mind in the marketplace right now for you?
As usual, we can fly by the seat of our pants because the over the last 2 weeks since the last episode, the market has provided, an economy in the world has provided its own fireworks and give us something to talk about. But we've had a lot. You have the war, I guess is the word, over with Israel and Palestine, Hamas. That continues, and that we always talk about greed and fear, so that definitely provides its fair share of uncertainty in the markets and concerns about other countries becoming involved, and it's spreading throughout the region. So that has put some downside pressure on the markets. I would say the last 2 weeks have been down for stocks, bonds, you name it. Oil, gas, and cryptocurrency is up because everybody's scared. But there's been a lot going on. We're smack dab in the middle of third quarter earnings season, which up to this point has been going well. We've had about 20% of the S&P 500 companies report so far, and I think about 73 to 75% of those have been positive earnings reports, better than expected. 60-some% have the revenue numbers have been better than expected, so which actually is pretty close to normal. So usually you have around 70% or so positive surprises if things are going well. So that's all good news. The bad news is interest rates have been bouncing around like a ping pong ball. Right. We've
that's been the common theme for the last let's say episode 8, 9, and 10. We've been talking interest rates and are they up, are they down? Well, not really are they dropping down so much as are they up, or is he going to make another increase or rate hike, or what's happening?
You've had that, and there's a couple interesting things influencing that. Number one is just the concerns, and he did speak again. Was that last week or the week before? And he came out once again and for the 18th time in a row told us that he's going to get the economy down to 2% inflation, and basically it doesn't matter what it takes to do it, whether that softens the employment market or softens our economy. That's his plan, and I'm talking about Jerome Powell, if I didn't say that. That he's going to do that, and he wants 2% inflation. So that has caused rates to go up because they just foresee that he's going to continue to raise rates somehow, some way. And we've been getting good economic and earnings numbers, so there's nothing in there kind of threatening him to not go ahead and continue to raise rates because we still have what appears to be a fairly decent economy.
Well, he was talking.
Yeah, the job.
But there hasn't been another rate hike.
Nope.
He didn't make a quarter point or anything like that.
Yeah, and we've talked about that before.
Right.
That he doesn't have to raise rates. If he can talk rates up, he accomplishes the same thing. The housing market is getting softer. We talked about people in the mortgage business. Some of the people I know in the business, their comments are, the mortgage business hasn't slowed down. It's stopped. They 6 months ago they were working their tails off, and now they're just sitting around twiddling their thumbs. Unless it's somebody moving or divorcing or dying or something like that, there's not really there's no refinancing going on or anything like that. Let's put it that way.
Well, I was looking for the word when you said, the mortgage, or the home buying, and as the home buying market or home selling market has softened. And I was saying, well, what's the other word? I mean, is it just turned to mush?
Yeah.
Because the conversation we ended with, 2 weeks ago on episode 10 was talking about where you had friends in the mortgage business who said, it hasn't slowed, it's stopped. So it hasn't softened, it's gone to mush.
Basically, yeah.
I mean, that's the question. However, that's painting that picture of doom and gloom. Mm-hmm. And gosh, last thing that we want to do here on taking stock is create that fear.
Yeah. We don't need to feed that beast. Let's put it that way. There's enough people out there doing that.
Yeah. Well, what comes to mind real quick on that, Art, is so do we want to feed the greed beast?
For me, the answer is no.
I was going to say
we're not. I don't want to feed either one. I'm the kind of guy I like when everyone's kind of reasonable and even keel, and things are going. Kind of like 2009 through up till 2020. Those were great years.
Steady earnings, steady increases in the market.
Yeah, earning. Interest rates were low, and earnings were going up, and the market went up with the earnings. It was all very, all nice, and with always a few speed bumps here and there. But
growth and gladness.
Yeah. Growth at the right price. So when we're looking to buy, if I'm looking for companies to buy, I want growthy companies, but I want to pay a reasonable price for those companies. And I think the problem we have right now, twofold. One, the earnings continue to go up. The earnings projections continue to increase, but the problem is at the same time we have interest rates rising, which lowers I call it the market multiple, but that limits the ability of the market to go up because the interest rates are higher, right? So we're kind of in that thing where things are kind of looking good, but really how much potential upside do we really have? The other side of the interest rates is there's a new term, or it's not a new term, but they've kind of shown their faces here again. They call them bond vigilantes.
Oh, wow.
And the bond vigilantes...
I was going to say you have to define what's the bond vigilante.
Yeah, it's these are the investors or the traders who like to express their dismay with our lack of a balanced budget, with how bad our deficit is, and they actually sell bonds, U.S. Treasuries, U.S. bills, notes, and bonds to express their displeasure, which, of course, if you're selling bonds, that's causing the interest rates, to go higher. So, so they're expressing, so you got that's kind of feeding on it too, and I don't disagree with their displeasure because we basically, I just saw a number yesterday, I think it was, that I think we're at 33.6 trillion on the deficit, where we were at 23 trillion at the beginning of 2020. So we're up over $10 trillion in 3 or 4 years on the deficit. So
trillion.
That's with a T,
right?
Not a B or an M. It's a T.
Yeah.
So that.
Well, we got way past the million a long time ago.
Yeah, and
But who would have thought we'd be talking trillions?
Yeah. I was in college in, I think this would have been 1988, and I had to give a speech. And it was a motivational speech or something like that. And my speech was about the national debt and the impact of it and all that stuff. And I was talking to them at that time about $1 trillion in debt. So from 1988 to 2023, we've increased the national debt by at least $32 trillion since I gave that speech. So it's, and we've made attempts. There was a bipartisan attempt a decade or more ago where they came up with a plan to get rid of our national debt, and it was going to take 50 years to do it. But they came up with a plan. This is how we're going to do it. Now, of course, it had to go through how many administrations and things like that, so they would have had to pass something that had some teeth to it. But that came and went and never happened. But now we're probably 3 times what we were.
Well, I was going to say, and we're this many years later, and instead of ultimately working toward that 50-year payoff, we've increased the debt.
Yeah.
Which brings me also to, because you mentioned already, things that have happened the last couple of weeks or that are continuing. No other way to describe it. What's happening in the Middle East is war, although there potentially are some favorable signs right now, at least with the Hamas releasing hostages and Israel maybe heeding the request to, hey, hold off on your ground attack or whatever. That aside, Biden spoke, President Biden spoke, whatever day, I lost track now. Today's Tuesday.
Yeah.
Thursday or Friday?
Thursday or Friday.
Yeah,
right.
Whichever day it was. And part of it is going to the House, which is, stalled, no speaker.
Right.
So, but he's going to ask for more money. So we have the Ukraine already.
Yep.
So he's asking for more spending to fund, essentially whatever it is, war efforts.
Correct.
Ukraine, now Middle East.
Mm-hmm.
There's a question in here somewhere.
it's more spending is the answer. So what are we doing to decrease the debt? Well, apparently nothing at the moment. We're talking about spending more.
Well, you were talking about seeing, bond stocks, everything dropping over the last 2 weeks since we spoke episode 10 of Taking Stock. It's been more of a decline. Is the spending having that big an impact that, can we say that's attributable to what's happening in the Middle East, on top of Ukraine, or not? I mean, that's the question. Is it the spending that's...
Yes. I mean, it's 2 things. One, it's spending. What are we spending it on, and how are we spending it? And I would love to sit down with someone and actually look and see what we're actually spending money on sometime. But but the other thing is let's look at our debt service. So we have the higher interest rates. Every time interest rates go up, well, when some of these stocks, or not stocks, but bonds, bills, or notes mature, they have to be refinanced because we're not beating down the debt. So we have to refinance. Well, guess what? 18 months ago, we were at 0.5% on the short end and a couple of 3% on the longer end, and now today we're at 5% on the short end of the curve and things. So our cost of doing business, our cost of financing that debt has shot through the roof. Right. So at least it's not a silver lining, but at least for a while there we had very low interest rates, and that's how we were funding our debt. Well, now, just like everybody else, people who took out business loans and things like that, they've seen their cost of doing business shoot through the roof because they had variable loans on their business and things. It's the same thing with the United States, where now we're paying way, way more for just the interest that we pay on our debt. So,
with these things happening, Art, how do we stay, and this is the term we've heard, recession-proof? Mm-hmm. Because with these things happening, somewhere in the back of our minds, and even just a few short weeks ago, people were talking, like, are we headed into recession? Mm-hmm. And you've been able to, walk some people off the ledge here on Taking Stocks, like, hey, we're not there. But what keeps us recession-proof with things going the direction they're going today?
Well, number one, the consumer is what keeps us recession-proof. As long as we continue to see the consumer out there spending money, we can stay away from it or prolong. We'll have a recession in the next few years. It will happen. I can't tell you when. we've in my 37 years, we've had several recessions.
Well, I was going to say, they're not, a recession isn't necessarily a bad thing.
Not necessarily, no. It doesn't.
And it doesn't have to be, what's the recession that we would point to that we say that was painful?
2008.
Right.
The Great Recession.
Right.
Yeah.
So a recession coming at some point in the next 3 to 5 years, for certain, or even any kind of indication that we're heading towards something now that somebody will refer to as a recession. Which, again, the definition of recession is what?
Yeah, two quarters in a row of a declining economy.
Right.
There you go.
So it's pretty, but that doesn't necessarily mean we achieve the pain threshold that 2008 brought. And then how many quarters did that last? Do you recall?
That was 15. That was at least 15 months. The market dropped. The stock market, U.S. stock market.
So that's like 5 quarters.
Yeah.
I mean,
Yeah, U.S. stock market.
I'm really good at
55.
math.
Yeah, I saw that. It's good. It's good. Yeah. No, the U.S. stock market dropped 55% in 15 months from 2007
That's
to
painful.
March. No, that's very painful. And then you also had housing values drop. But here's the thing.
Yeah, I felt
we
that.
put our and a lot of people did. You always say, what's the difference between a recession and depression? A recession is if your neighbor loses their job. A depression is if you lose your job, right? But
Amen.
2007, 2008, beginning of 2009, there were households in our area that both people lost their jobs, and depending on how they ran their financial life, their fiscal life, determined how well they did during that time.
Sure.
If they were heavy in debt and things like that, it was very, very painful. Well,
I interrupted your answer to the question, how do we remain recession proof? And you began, taking us back a minute ago, you began with, well, a recession's going to happen. They do happen. So, what's the rest of that answer? Since I cut you off, I apologize.
We've talked about this numerous times. The consumer is 70% of gross domestic product. Yeah. So if the consumer's hanging in there, that's going to go a long way keeping us from recession-proof. Then you got to watch imports, exports, government spending, investment, thing like that. But that's number one. I think number two. It's a good question, but interest rates are going to be the other thing. If we can't afford to buy cars, if we can't afford to buy appliances, if we can't afford food, that's going to put negative pressure on the economy. And again, it could be a definition of a recession. Could be if we lose 0.1% in this quarter and 0.1% in the next quarter, that's a recession. But that doesn't mean it's painful. But we start to go into a recession. Then what did we do? Then the normal thing would be lower some interest rates and get the economy going again. Okay, well, Fed Chairman Powell, the Federal Reserve, they want to drop inflation. We're at about, let's say, 3.7% right now, but they want to get it down to 2%. Well, what happens if 2025 we run into a recession? Now they still aren't where they want to be from an inflation standpoint, but at the same time they got an economy that's starting to chill and start to slow down. Well, they can't. If they lower interest rates, then that goes back to fuel and inflation. So, and I'm not in no way, shape, or form am I trying to say that this is an easy task. Right, the whole negotiating what they call a soft landing, trying to get the inflation under control but keeping the economy going at the same time. It's not easy, and you're playing the same game I'm playing. I'm trying to invest based on where I think things are going to be 6, 12, 18 months from now. Well, that's exactly what the Federal Reserve is doing. They're trying to, turn the faucet on a little bit, turn the faucet off a little bit, and try and negotiate that soft landing. So.
I was gonna go into some kind of analogy as like keep the engine running, slow the engine, but don't stall it.
That's right.
Slow the engine, don't stall it, don't kill it. That's a tricky thing. You got that's soft on the clutch, right?
Well,
soft on the brakes.
Yeah, that's a great analogy. And And then here's the thing: like you look at the economic numbers that are coming out now, they're not pointing toward a recession. Those numbers that we're seeing today are not, in my opinion, they're not reporting. I mean, there's some softness here and there, and but the thing is there's Wall Street and then there's Main Street, right? If you take a look at Main Street around here, you can see where there are certain places in our socioeconomic structure where some people are really starting to struggle. Mm-hmm. If you talk to the food pantries around here and things like that, I think if you talk to Life Food Pantry, last year they served, I don't know. The point is all of last year and through September of this year, they're already 60% higher than what they were.
I was going to say
the
simple thing and Life Food Pantry here in Loveland mm-hmm. is we see, I do, I'm sure you do. I know you're an active supporter of Life Food Pantry. I report the information that they share with me regularly. So you and I both are seeing that specific number. So, the simple way to say it, as opposed to like how many families, the bottom line is there's an increase in families in need.
That's right
here in Loveland.
Right.
So,
a substantial.
And again, that's that, hey, I might be having a little recession, but they're in a depression.
Right.
I can't sit here and say they're in a recession and I'm not.
Right. So, and exactly, and then the question becomes, that their spending power, the lower part of the economic spectrum, their spending power might be less. So, but if that what's happening down at the lower class or whatever you call it, lower middle class, if that starts to work its way up and you start to see middle class and upper class starting to curve back on their spending, that's when you're really going to start to see some changes in the economic numbers. But
well, I always look at when there's only one line, and it's the haves and the have-nots, mm-hmm. and the middle class keeps shrinking. That's I think that's what you're referring to there.
So.
You touched on I forget how you just said it, so I won't even go into that. But here, my question is this, and I don't expect you to have an exact answer, but an idea. What is a dollar cost? Because that consumer spending we were talking about as the number one thing in terms of being recession-proof is consumer spending. And then the number two thing is the interest rates, which is ultimately, the cost of a dollar to you and me. Because my other question, which I asked last week, is, well, are the people that we see out there spending, Main Street's doing everything, and that's great to see, but are they doing it on credit? Mm-hmm. Are they spending money they have to spend? And there's nothing wrong. I mean, I pull out my credit card, thankfully pay it. But if you're paying, carrying that, credit beyond the first month, now you're paying what? On a credit card, maybe you're paying $1.20 for $1.
Yeah.
So that's when I ask that question, what's a dollar costing you and me these days with the fact that interest rates are now factoring in? Mm-hmm. And that's on, we're talking big ticket items. We're not talking about somebody goes out to dinner and flips out a credit card. We're talking about when you go to the bank to buy $1,
right.
To borrow $1, mm-hmm. and which is you're buying $1 to buy a car or an appliance or a home when you talk mortgage.
Right. Well, I mean, if you look 3 years ago, my mortgage was 3%.
Right.
Now we're hitting 8s.
I see.
So whereas let's just say my mortgage was $1,000, now it's over $2,000 for that mortgage. If I go to the grocery store, I always use the cheeseburger, right? Yeah, the cheeseburger's not $5 anymore. The cheeseburger's $10. And so that's so the cost of going to the grocery store is up. If I go buy gas, if you look where gas was, 3 years ago, 4 years ago, we're up 50%, right? So right somewhere in there, we're up 50%. We were 2 something a gallon. We're now at I think 3.30 today. So your cost has gone there. But you to answer your question and kind of go on the point you were making, that we pumped $6-7 trillion into the economy over the last 3 years. That money has almost dried up or dried up. So now you are correct. We're not spending that. We don't have that money. We're not spending that money that was given to us over the last 3 years. So that's gone. You are starting to see credit card debt and things like that go up because, that's wonderful. We get down to 2% inflation. I do all my work based on 3% inflation. That's how I run my models and do my work. But so we get down to 2%. Well, that's great, but guess what? That doesn't mean the cost of a cheeseburger, or cost of gas, or the cost of whatever is going to start coming down. All that means is that instead of the cost of living, instead of going up 8% per year, now we're only going up 2% per year. So we're not backing the prices down. So somewhere in there, either this economy needs to pick up, and we get better growth in our economy, or somehow we have to start figuring out a way to pay down our debt.
Yeah, that's the old. There's no going back.
That's right.
Once the retailer, I'll say, is able to charge us a price, he doesn't reduce that price when things settle back down.
And we went for 2 decades, 3 decades, where really manufacturers and things like that, they were not really able to pass on price increases. Well, that's changed in these last couple of years. They've had to, and they've done it. It's right. There. It is, and the supply chain still messed up too. So there you have that. I mean, it's better. There's no doubt that it's better. It doesn't take 6 weeks to get a door now. Now it takes 2 weeks when it used to take a week. So it's right. still ebb and flow is still.
Well, the good thing is some of that comes back. Like you said, supply chain problems are dissipating. We're coming back. We're at my favorite part.
Is that the end?
No, well, sort of. Yes and no.
Yeah.
No, we're not quite at the end, but yes, we're at the end. The favorite part is, I like to say, no matter what we've talked about, if there's been some fear that we've talked about or something that might make somebody shake a little bit, we get past that and we talk about, so what are the positives that you're able to share with our listeners today? Me and all my friends that are just the Main Street investors or Main Street dealing with our home economics.
Yeah.
What's the positives?
How about the sky is not falling? We'll go with that.
Okay.
It's not. This is not 2008. We are not on the the abyss of a major financial recession. Where the economy, the markets are not about to drop 50% or something like that. Maybe depending on your age and things like that, maybe you do look at some alternative. The nice thing about interest rates going up, the silver lining is now you can go buy bonds at 5.5%, whereas before you could get them at 0.5%. So,
right.
So you can, if you're willing to accept 5.5% to alleviate some of the volatility, you can do that. So you can still get 5.5% return, but not have your portfolio bouncing around all over the place, or some combination of the two, right? But yeah, it's. I still say we're not. There's nothing in the foreseeable future that indicates we're in trouble. Now, my caveat to that is always unless somebody does something stupid, right?
Right.
And in my humble opinion, there's been a lot of stupid lately.
Well, there's good, which is unless somebody does something stupid, and that includes me and the rest of us on Johnny Main Street, and so we could probably say this in unison. So the message remains: stick to your plan.
Yeah.
Right?
I was trying to say that without actually saying that because I was afraid I was starting to get repetitive.
We say it all the time. No, that's why I said we could probably say it. And sorry, but you didn't join me when I said stick. You were supposed to just say to your plan.
I'll let you say it.
But that's okay. So, folks, that's going to wrap up episode number 11 of Taking Stock. And once again, Art Jarvis, thank you for being with us, sharing your insights.
My pleasure. Enjoy it every time.
Look forward to having you back in 2 weeks.
Yeah, sounds good. Thank you.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition, Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.